people who actually make these deals happen are at various career stages. So the first stage, before you can be an intern, but the first real career stage where you've been hired into the company on a full-time basis is as an analyst. And so an analyst, basically what you'll be doing is you'll be building a lot of financial models. It's like a financial modeling boot camp on steroids, and it lasts somewhere between 2 and 3 years, after which you'll be expected to go to business school and get your MBA, or a very few are sometimes offered a promotion straight to associate, or sometimes they'll move from the sell side to the buy side. Buy side examples would be at the very largest, like Colbert Kravis Roberts, Clayton Dubilier Rice, Forsman Little, and some others, and then there are lower ones still, and there are specialist ones on the buy side. But essentially, in addition to creating very, very comprehensive and detailed financial models, you'll also be creating what we call pitch books. So the primary job of a managing director becomes getting new clients, otherwise nobody has anything to work on. So what we'll do in an effort to win the engagement is put together essentially a 60 or so page deck talking about our team, where we are in the league tables, past transactions that we've done, case studies, evaluation, most likely selling price range, what a process looks like, and so on. And so it has to be letter perfect, because anything that's off, whether it's mispunctuation, whether it's misspelling, it's going to make you look sloppy, and you can't have that. And so attention to detail is paramount, and it starts with an analyst. And so you'll also, as you get more senior responsibility, so after your first year into your second year, you'll be trusted with some of the qualitative work as well from a first draft perspective. And so you'll be doing things like running valuation comps, you'll be looking at precedent transactions, you'll coordinate due diligence materials. So for instance, once we have a company, once we've signed what's called a letter of intent, we then enter into exclusivity. In exclusivity, that now means all the claims and representations that we've made about the company are going to be verified. And so the first thing that starts is you'll get a huge list, a due diligence list, of all the information that the buyer, their lawyers, their insurers, and their commercial bankers are looking for you to provide to them, so they can begin the work of verifying those claims and representations. And so you get the fun task of going through those and figuring out which ones are applicable, which ones aren't. But as an analyst, it doesn't start and end with you. You'll have a team over you that's been there, that's usually started their careers as an analyst as well, and it's just progressed. And so the next stop, usually after MBA school, is going to be that of an associate. And so here you'll be doing more of the qualitative work, but you're overseeing the quantitative work that the analyst will also perform. So you'll be doing things like reviewing the models. Your fun there is like finding a conditional nested if loop, seeing if there's maybe a sign flip for why is it the numbers don't work, just to give an example of what it is you'll be sorting through. You'll start with taking notes on client interactions. Most analysts aren't on calls, though they might be in the room, they certainly aren't heard. Associates might maybe be. You'll be supporting the vice president who will be running the day-to-day process of, so I call it kissing the frogs, and you'll kiss a lot of frogs. We'll go to upwards of 100+ potential acquirers, all in a qualification exercise to try and see not only who has the financial wherewithal to effectuate a transaction, but also trying to get a sense of price, terms, fit, and reporting responsibilities. Different sellers will have different goals that they're trying to achieve in any transaction. And so you'll start to get a feel for how to marry one versus the other when we put together ultimately what will be an enterprise value comparison matrix when comparing offers one against the other. But you'll be the one taking notes once you're an associate. You'll be the one also who will be responsible for the data room. There are 2 data rooms. There's one when we're going through a sell-side process, trying to figure out who the ultimate acquirer is going to be that we will go into exclusivity with. But then while we're doing that also, there's what we call a data pack. So they'll want to see essentially on a monthly updated basis how the company is progressing through what's usually a 3-month or 90-day marketing window. And so then you'll also curate the buyer lists. And so these are all the potential acquirers that we will market to. And so that's one where there will be multiple review sessions to figure out, are we sending these materials to those who should be taking a look at the client that we are representing? And if so, if they're not responding, who it is that hasn't responded, where they're stuck, and so on. That way, when we have weekly client update calls, you're the one who's updating the weekly tracker and also internally the CRM to make sure that we are effectively running our marketing window and not letting anything slip through the cracks. Once you've been an associate for a few years, you can expect, by the way, you'll be working somewhere on a light week, it'll be about 80 hours. On a heavy week, it'll be about 110 hours. It'll just be about the transactions, the volume of transactions that we're representing at that time and what stage they are in the process. So as a vice president, you're overseeing the team of analysts and associates. So one vice president's usually on a deal team, usually at least 2 associates and at least 2 analysts, could be larger depending on the size of the transaction and its complexity, but a skeleton team would be 5 juniors. Junior is VP and below. And so you, at this point, as the VP, you're the one who sleeps the absolute least. It's the hardest position, but the most important position from a deal execution perspective on any transaction team, because you're the one who has the primary kind of boots on the ground, where you're having the initial conversations with all the potential acquirers, and usually you're talking to somebody who is kind of at a VP level there as well for the beginning transactions. The directors and managing directors won't start getting involved in that transaction until we start to see an indication of interest. So that's when we're normally will provide a process letter once we send our marketing materials along with the teaser. We send a teaser and an NDA. Once the NDA has been executed, they receive the SIM and the data pack along with the process letter. And so in the process letter, we give dates. And so the very first date is what's called an indication of interest, or IOI date. And so we want to run an efficient process and only spend time with those who have really shown investment into the process. Otherwise, you'll be talking to a lot of people ineffectively. And so if you don't get an indication of interest, a managing director is not even going to think about picking up the phone to talk to these people unless it's such a high value acquirer that it's kind of a condition of their acquirer's process that it's a senior to senior call. That is sometimes the case, though that's more the exception than the rule. So what happens then is once the VP has had all the primary interactions, we now start to have what we call our cut. And so we'll look at all of the indications of interest in the typical process, depending on just how desirable or thin the desirability is for the particular asset that we're representing. We'll usually get on a low end about 7 offers, on a high end maybe closer to 15, and we're trying to send out somewhere between 60 and 100 SIMs. So it's a funnel, it'll narrow its way down. And so the senior attention starts coming once we've gotten to indications of interest. Now that we've gotten some investment in the process and we know who the true runners on the track or players for this asset are going to be, it starts to become more of a senior to senior interaction. So we'll be talking not just, let's say for instance, it's a PE portfolio company, meaning a private equity group has a large company that they're trying to scale over typically about a 5-year hold period. Could be shorter, could be about 3, could be longer, could be about 7, but most typically about 5 years is how the internal rate of return equation maximizes returns for that private equity investor. And so depending where they are in the hold period, that'll tell you just how much of a runway you have as a seller for rolling equity. And so all of these things enter into the conversation when we're trying to get a sense of the price and terms, which usually have 3 levers that are indicated in that IOI. So the first, of course, is cash at close, and that's kind of the one that garners the most attention and appreciation from your seller client. But then typically along with that, we usually are selling an asset that is on the ascendancy, meaning a growth company. And so there's a difference between where they are today and where they will be tomorrow, and what you're really buying as a buyer is a future stream of expected free cash flow discounted back to today's dollars, or what we call a net present value. And so it's just an argument of how likely is this asset to achieve that result. And so usually on the buy side, what they'll be doing are multiple iterations that come in at least 3 flavors, what's called a downside case, meaning what happens if something goes wrong, a base case, meaning this is probably about a steady state, what we expect the company to do, and an upside case, meaning what happens if some large pipeline opportunities, maybe in their sales pipeline, convert, and now it exceeds forecast expectations. So these are all the things that go into the 2 other levers, which would be either an earnout, which nobody likes but everybody recognizes is a way to bridge the gap between where a client is and where the client will be. And then there's ultimately something called rollover equity. And so this could be if I sell my company, and I own 100% of ABC company, and I'm selling to XYZ company, I no longer exist as ABC company. They're going to dissolve me, and I'm going to essentially roll either my stock or my assets into a new co or new company, and then ultimately I'll then be acquired. And if I roll equity, let's say 25%, the question then becomes, what is the 25% of old co worth in terms of share price of new co? And that becomes a contentious kind of fun negotiation that again would be at a senior to senior level. So these are the process points that either a MD or partner will typically negotiate, and that gets reflected ultimately in the LOI and in the purchase agreement. And all through this, as you could imagine, it's not just about the numbers, but imagine, if you will, a seller, somebody who's run this company 20, 30 plus years. They've foregone the comfort and security of a corporate job to take something typically from idea to large institutionally attractive enterprise. They most typically, if they're a first-time seller, have 90% plus of their liquid net worth tied up in this one illiquid asset, the company, that we're helping to seek liquidity for. And so you can imagine there's some emotions that run through this, and there's some moments of questioning, some moments of doubt. And so your job is to make sure through what is usually a 9 months, a year-long process that ultimately you're able to hold their hand through this pitfall-infested jungle that we call an M&A process, and make sure they come out on the other side of it with the millions of dollars that it is that they hired you to ultimately achieve for them. And so there's a lot of armchair psychology and psychiatry that goes along with this. And so that's once, of course, you've won the engagement and have gone down the process. But your primary job as a senior, in this case as a managing director, is to bring in new business, or otherwise nobody has anything to work on. And so that's a little bit about the roles and responsibilities for what makes up an M&A team.